Hello everybody, Brandon Diaz here, real estate investor, crypto enthusiast, and I come to you a video today with talking about real estate and also inflation. So I'm a part of these Discord channels based on the crypto NFT projects, and this one specifically, Sneaky Vampire Syndicate. And the conversation that we were having was talking about inflation, and what we were talking about was, or I'm sorry, we were talking about interest rates going up and how they've been spiking, and also how price of lumber has went down. And basically, the effects of that basically means that we're going to be dealing with a like a housing recession or a housing correction, I should say. And I've heard that opinion a lot. And what I want to do is I want to give my perspective and my opinion. Again, it is just a different perspective. I've been in the real estate field since 2010, buying and selling houses, not as a real estate agent, but as an investor where we actually buy, fix them up, and then sell them and rent them. I own property all across the state of Tennessee, from Memphis, Tennessee, Nashville, Tennessee, and Chattanooga, Tennessee. And I've fixed and flipped over 300 houses at this point. Now, I only just say that just as an understanding of my own experience. I definitely have friends. They would laugh at that and they would say, "Oh, you've only done that many." You know, they've done thousands and they've seen multiple cycles, not just since 2008, 2010, but they've seen cycles even since, obviously 1980 and so forth in that direction. So not to discredit on that side, but I did want to give a perspective because we're dealing with different elements that we didn't have previous to even the 2008 market crash. As an example, back then we were actually dealing with over borrowing where banks were just willing to give you a loan, and on those loans they also had balloons on those loans, and those balloons would balloon within like 2 years to 5 years. And they had given so many loans out because the banks had gotten greedy that what ended up happening is that they all came due at the same time. So an influx of inventory, then you had banks going out, and it was just a trickle-down effect at that point. Okay. Now we don't have that same kind of over borrowing from homeowners, the same as we did back in 2008. And what we also have to understand is, like, companies like BlackRock back in 2008 just started getting into the game in single family homes, meaning they were buying single family homes that these big hedge funds weren't purchasing previous. Now hedge funds have been buying and gobbling up houses like never before, and they're paying cash for these houses. And they're typically what they're purchasing is starter homes, single family homes, starter homes in like any location. So I'm just reading one article. I'm not going to go into the article, but there's many articles like this, and they've been talking about how hedge funds are continuously keep growing into this space and continuously keep growing in this field. And in this article, what they were saying is that the market currently right now is made up of about 2% of hedge funds owning real estate. That's only 2%. So really a small amount. And again, because they've only been around since 2008, really starting this purchasing power, and now they're picking up more and more and more. And more companies, more hedge funds, like you got like JP Morgan Asset Management, Blackstone, Goldman Sachs Asset Management. There's more that are just coming into the space, more and more and more every single day. And in this market, and in this article, what they were talking about is what they wanted to do was put in about $5 billion more into buying real estate, specifically for real estate over the next 5 years. So $5 billion over the next 5 years. And I did the math just off of that, just off of what they're talking about currently right now. That would increase their ownership from about 2% in the marketplace to about 4% in the marketplace. And I only think that's only a few. I think it's actually going to probably over the next 5 years, maybe even increase even higher than that. So what ends up happening is if you're talking about hedge funds competing in the market, they're competing against home ownership. So you can raise interest rates all you want. The only people that you're taxing in that direction and making it unaffordable is you're making it where the homeowners cannot afford houses. So they're priced out of the market, leaving it where there's an open playing field of hedge funds just being able to purchase houses more and more and more, making it unattainable for people to be able to have home ownership. And I think that's actually what we're dealing with. Another thing is just because lumber prices are going down doesn't mean that actually means that there's more profit margin for maybe the investor. The investor is the one that's fixing and flipping the houses. If the prices of houses stay the same and the prices of lumber or material go down, that actually wedges for a gap. which may increase the amount of people getting into the field, certainly. So that means there may be a little bit more inventory. But I don't necessarily think that just because prices of lumber going down is necessarily going to mean that the prices of real estate is going to go down, because banks still evaluate what houses have sold for. As long as there's not an influx of inventory in the market, then we may not actually see like a price market go down. Now, in my opinion, we may see like it goes stagnant, like meaning that prices just kind of flatline. I could definitely see something like that. But we're going to have to see, at this point in time, we are extreme low, not even just low, we're extreme low. So even if there was an influx into the market, we may just still be in low, or maybe just in a position where we're in an average market. We'd have to see a humongous influx of housing hit the market, which again, these hedge funds would just gobble those things up in a heartbeat at this point. Okay. So that's just my take on the market as far as like interest rates going up, is that I think that it's actually going to be damaging to the home ownership, but not damaging towards real estate and not damaging towards these hedge funds. I think it's going to be a benefit to the hedge funds, where now this becomes a product that they're going to be purchasing. Now, going into really inflation, this is what we have to worry about, because again, the government is printing large sums of money. And what's happening is when you have large sums of money, it inflates the prices of all assets, real estate, rents. You're going to be looking at food prices, gas prices, which we're seeing, and that's a big topic at this point. So what I want to do is give you a perspective in thinking about why it's important to get into real estate and using debt to purchase that real estate. Okay, so if we look at this, now switching over. All right, so the numbers that I want to use, I'm going to say that, let's say that we can purchase a house, and let's say it's worth $100,000. Okay. Now, in the real estate field, we would call that fair market value, FMV, or after repair value, ARV. But let's say that we can purchase this property for $90,000. Okay. At $90,000. Now, you would see probably a $10,000 difference there, and you'd like, okay, I could sell it, make $10,000. But the reality of it is that's not real numbers. The real world scenario here is that you would probably actually break even in a situation like this, because if you were to sell for $100,000 and you're into it for $90,000, you still have real estate agent fees, closing costs, and then you also have like some contingencies. So I just run it at about when you go to sell a property, I always just assume that there's about a 10% hit that you're going to be hit whenever you go to sell the property, okay? So just keep that all in mind. But let's just use the numbers of where it's at right now currently. Now, let's say that you can rent this property out, and we'll just say that you can rent out the property. Let's say it's roughly about 1% of the $100,000. Now, that's getting harder in the market today, but you are still able to find deals just like this. But let's just use the numbers. I'm just trying to show you what inflation does. So let's say that you can rent this property for $1,000 a month, okay? Well, here's the benefit of being able to buy a property or buying a property, is that you get to use fiat cash. So right now I'm talking to the crypto field because, we like to talk in Ethereum, we like to talk in Bitcoin. But when it comes down to real estate, obviously people run in the fiat currency. But the benefit is that we can borrow that money. And a lot of people don't realize that on average, we've been, as far as interest rates are concerned, we've been dealing with the really way too low interest rates, and we've actually failed to realize that on typically when it comes down to interest rates historically, that anything below 9% is actually a decent interest rate. So let's say that you could borrow, let's say we'll even go even higher than that, and let's say that the interest rate is at 12%. Typically, when I'm borrowing, I'll be borrowing interest rates typically for myself is somewhere between 9 and 11% initially, and then I can go to the bank and then refinance at that point in time. But at the beginning, I'm borrowing from, private lenders. These are individuals that I know that are doctors, lawyers, or they've gotten into businesses. They've made a lot of money, but they're not really in the real estate field per se, and they just want to take their money and lend it out. They're not banks, is the whole point, and they want to make money off of that money. So what I do is I borrow that money at a higher interest rate to initially acquire the asset. Once I've acquired the asset, then I can renovate the property. I can rent it out. I can stabilize it. then I can structure the debt later just by acquiring the asset. So what's important is acquiring the asset when you deal with that. But even if you are dealing with a higher interest rate, let's just use a 12%. Let's say that we're dealing with a 12% interest only. And let's say that you can borrow this money, the entire $90,000 at 12% interest only. So then if you go 12%, now one way you can do this is just literally go 1% per month, because usually interest rates are based upon annual percentage rate. So if you go 12 and divide it by 12, if you go 12% interest rate divided by 12, that would give you 1% per month. So you can actually just go 1% of 90,000, which would give you $900, or you could go 12% divided by 12, and it'll give you the same number. So then that means your payment is roughly $900 a month. Now that just includes interest only. Now that does not include, you have your taxes and your insurance as well. So you're not actually receiving a $100 difference in this situation, because again, your taxes and insurance, just being forthcoming and showing you here. It's what I'm doing is I want to show you what inflation does. I'm just trying to give you an example here, okay? But here's the thing, if we know, like right now, the Fed, just as of 2 days ago, said that the inflation was 8.6%, was how much inflation occurred just on our money. So that means all of these items just went up 8.6%. So then what that would mean is, so I'm just going to add these two together, that means that just within 1 year, that property, that same property, just based on the value of the dollar losing, ended up making, I'm sorry here, $108,600. But the difference is that you borrowed the $90,000. This did not go up. It's the value of the property went up because the dollar had went down in this situation. And that means year two. So typically, whenever we talk about inflation, we're really talking about inflation roughly about 5% is what we talk about with inflation. The reality of it is that they're using this inflation based on what's called, sorry about that, consumer price index, which is the lowest form of inflation. So in past tense, consumer price inflation, they would basically say that inflation was roughly about 2 to 3%. Okay? But what we were really seeing based upon that 2 to 3% was more like 5% to 6% in real world terms. So if they're talking 8.6 is based on consumer price index, then what we're really seeing, and this is what I'm basically seeing in the market, is that we're really seeing more like double that. And we've been actually seeing more like 15% to 20% true inflation on that consumer price index. So that means that property value is really increased up to like $115,000, just okay, to $120,000. Okay, let's say that we are able to manage that next year. Okay, and we manage that, and let's say that we're able to lower that back down to, let's say, a 5% inflation rate. Well, then that means that we're now at a 5%, which means that this increased in value another $5,000, okay, well, we'll say 6%, to another $6,000. You see what I'm saying here, okay, 6K. I meant to put the dollar amount here. So then that means that the next year, year two, it's worth $120K to $120, we'll go $126,000 in this case is what this price will be at. Even if we go with the government's number, and let's say that they're able to get this down to 2 to 3%, with 2%, we'll just keep that on 100,000. It actually, it compounds itself. But let's say we're able to get that from 2%. Well, that 2% would still mean that this increased to $110,000, okay? And this is a challenge that we're going to be facing forever when it comes to fiat. So if we're talking fiat money, even if we're able to lower this down to 2 to 3%, over a 10-year period of time, that's 20%. So 20% of this would mean in 10 years, if we were just going off of the government's numbers, then that means this property will be worth roughly about $130,000. based on the government's numbers. But if we're looking at a true inflation, then and they were able to lower this down, we would still see about a 5 to 6%. So that means over a 10-year period of time, that means an additional $50,000 to $60,000, an increased loss of dollar power, but an increased value of our property. So over a 10-year period of time, 170, so we'll just go 180K. But the problem is, or the good thing I should say in this case, is if you borrowed the money, even if it was only at an interest-only payment, meaning there was no principal reduction, and you're still paying 1% a month, and that's at a 12% interest rate, this never goes down. This continues being locked in, so you're essentially buying these assets with today's dollar value, knowing that the value of the property will go up, giving you the difference here. Whereas if you just hold the cash, you lose your purchasing power and you're not able to buy, we're talking about baby formula, we're talking about gas, we're talking about rents. All of that continues to rise, so your purchasing power gets less and less and less. So this is just a different perspective, a different thought. There are better numbers that I can show, and I can give some better experience numbers based on some of my own properties. But this is just, I hope that this made sense. Again, this is a video on inflation and talking about the real estate market. If you guys are interested in this type of content, make sure you subscribe, like, comment, share. This is Brandon Diaz, and thank you for watching.